The Fed decision is out, and apparently they're going to keep buying bonds. Joining me to talk about the latest FOMC statement is John Lynch from Wells Fargo's Private Bank. Welcome, John, and tell me, did this surprise you?
Thank you, Greg. No, I'm not necessarily surprised. A lot was coming in to the meeting, particularly after the minutes for the last Fed meeting came out, and it appeared that there was some dissension. But when we see slowing economic growth, weak employment growth, and today's manufacturing report, for example, I'm not surprised they decided to persist.
Inflation still doesn't seem to be a problem with them. They're looking at the job side, right?
Absolutely. They're looking at employment, and while the unemployment rate certainly has come down to maybe 7.6%, I think they're paying more attention to the underemployment rate, which represents those who are maybe working in jobs that aren't reflective of their educational credentials or professional credentials, if you will. So that number's closer to 14%, so I think the Fed's really paying close attention to employment.
According to their verbiage, they see the economy expanding at a moderate pace. Do you agree with this? Is this how you see the economy?
Yeah, I have to agree. I think we're in this new normal type environment. Unfortunately, housing, even though it's improved, we saw a good number yesterday on the year-over-year price. We still aren't see housing, employment, and to some degree, credit participate to the extent they have in previous economic cycles. So I think the Fed's very concerned about that, and in spite of their efforts, they're not seeing too much bang for their buck, if you will. And I think they're really paying closer attention to the deflationary threat. Everyone wants to talk about inflation, but I think deflation is something they're watching out for as well.
And they certainly have no worries about a potential bond bubble. We saw Apple sell $17 billion worth of bonds yesterday. Microsoft was selling bonds last week. Does this unnerve them at all that you once had a mortgage bubble? Now people are talking about a nascent corporate bond bubble.
Well, I think that's something they have to be very mindful of. They've got quite a balancing act, and I think that deflationary thing is something we need to touch on, because when you see the bond bubble resulting, it's a search for yield, correct? And the only area that really seems to be working for the Fed now is risk assets, the perception of risk, if you will, whether it be bonds or stocks. You know, we've seen a flattening yield curve. We've seen commodities fall out of bed, yet equities are at a record level. Something's got to give, and it looks like the equity market is the only thing that's really responding to what's happening with monetary policy.
Well, clearly the Fed has put its whole self in. The big question is, can it get out? What do you think?
That's the big question. You know, if they keep this pace up, we'll go from a balance sheet at the Federal Reserve in August of 2008, about $800 billion largely in treasuries, correct? Now we're looking at about a $3 trillion balance sheet, and if they keep up $85 billion a month for the course of 2013, which appears to be the case, we'll be looking at a $4 trillion balance sheet. How do you unwind a $4 trillion balance sheet? Very carefully. And I think what we're going to see, you know, it's conceivable you and I may never see the Federal Reserve sell a treasury bond. They may just have to let everything mature because there are so many holders, right? The Japanese, the Chinese, the EC, or not necessarily the ECB, all the institutional investors, things along those lines. And the Fed doesn't want to lose on their investment either. So we could see, I think it has to be open to discussion now, the possibility that the Fed holds on to treasuries, lets them mature over time, and as economic growth improves, as we see a bid on inflation or wages, if you will, I suspect we'll see the Fed start to unload some of the mortgage holdings, perhaps sell off packages to maybe some of the investment banks or some of the larger investment firms.
Well, we'll have this discussion again in mid-June when they meet again. Thanks a lot for coming, John Lynch.
Thank you, Greg.